Welcome back to Money Discourse. Coming up, the 10-year Treasury spikes after stronger than expected data, and Jay Powell says that we still have 2 rate rises on the way. The Bank of England raises rates by 0.5%, and is quarter-end rebalancing pushing up large cap stocks? Rajan, take it away.
Yes, I mean, we spoke last time, and then this rally is still going strong. Although we're off a little bit from the highs, we're still seeing a real strong trajectory, and we took out last August highs. So we're literally trading at the highest levels in about 10 months right now. And the thing is that there's a lot of talk on Twitter. Number one is that you're seeing Apple just literally just inch up every day, pretty much hitting $190. So it's like, I don't know what that valuation is, but it must be well over 3 trillion. And is it because, this rally has been so led by tech and this AI boom, and all these money managers have to make sure and show on their books that they're long all of these names. And is it because of that you're seeing this drive towards a quarter end? I mean, basically tomorrow, June 30th, that's it for the quarter, and we start again in Q3 on July on Monday. And plus, it's a holiday weekend over here. It's going to be very quiet on Monday. July 4th on Tuesday, so the markets are shut. So, I mean, you've got all of this because, I mean, we've seen this market continuing to go high, and the whole talk about interest rates now just seems to have no effect. I mean, we saw Powell talking about 225 basis point hike potentially on the table, and we did see a sell-off in the Nasdaq from the highs yesterday. But if you think about it, it wasn't really, I mean, in the grand scheme of things, it was a small move. And then today we had initial jobless claims in the US that had the biggest decline in 20 months. So, I mean, the job number, like I was speaking to you last time we spoke, I mean, it doesn't seem like these jobs are going, even though all this talk from everyone that, savings are going to deplete here, this and that. And we had the final read of GDP, which was around, was it 2%? And that was above the 1.4 estimate. So we're getting GDP above consensus. We're getting jobless claims down. And despite that, and we're having a more hawkish Fed, but despite that, we just keep on rallying. And so we did see a little bit of a sell-off earlier because these PMI numbers out of Europe showed a bit of a slowdown compared to the previous trajectory. But other than that, I mean, everything looks good. And I mean, yesterday after close, I don't know if you saw it, that there was all the tested banks in this 2023 stress test passed. But I guess it only passes as long as there's not a bank run. So, I bet SVB would have passed that stress test. I mean, like I said, I think these stress tests, they're a bit pointless because, I mean, if there's a run on the bank is done. I don't know how, unless the Fed keeps on bailing them out. And we saw about SVB, right? The bailout, how literally just a few big clients that got saved by this bailout, which is pretty crazy. But overall, like I was saying, if we have a look at where the market is right now, and we can see this since pretty much the end of March, we've literally gone up almost 600 S&P points. So that's almost 20% on the S&P. On the Nasdaq, it's more obviously because you've got a lot of tech names in there. But again, here was that little pullback, which actually timed perfectly. Went down here, and now we sort of bounced back up a little bit. But I mean, to be honest, the trend is your friend. And we were in between this sort of range over here, as you can see. And so, I mean, potentially we can get to 4,500. And I mean, I didn't think it was going to happen, but can we hit all-time highs? It's only about 300 points away, 350 points away. And if Apple keeps on going up every day, if Microsoft keeps on going up every day, and all these big tech keep on going up every day, I mean, even though it does not represent the broader market, the big caps are getting so big and having such a bigger capitalization that, I mean, it's very possible that we take out those highs. Although I don't think it should, but we'll see.
Even though these large caps are going through the roof, it seems like the small caps remain historically cheap. The only larger valuation cap over the last 50 years was the dot-com bust. So what's your thoughts on that?
Yeah, I mean, that's pretty much right. I mean, you're looking at some of these small caps and they're still 60, 70, 80% from the highs, whereas large caps are all going through the roof. The thing is that obviously, you've got, annoyingly, like I said before, I don't have Microsoft on an individual basis. I do have it just as part of the S&P 500. But like, I've got, I've always said I've been a, hold of SoFi and Moneyline. That is my little bet still. It's just worth peanuts right now. But that's just my little bet, little lottery bet that I think could come good maybe later on down the line. But I do think there is a lot of space in the small caps, a lot of room in the small cap space for some big winners. You've seen these regional banks, a lot of them are still really depressed. So I do think that the risk to reward in that space is definitely much better. But right now, large caps is leading, and so you need to have some type of exposure to that in order to join in with this rally, considering it keeps on going up. But I mean, we are seeing some of these, like today, Greenbrier reported results, and the shares are up almost 30% today. They had a big beat on top and bottom line. They raised their outlook, and we saw Snowflake. They had a pretty bad last earnings where I think they cut their guidance, but this time they actually had an investor day a few days ago, and they raised their 2029 outlook. First of all, I don't know how you can even forecast 6 years into the future, but they did. So they raised their operating margin forecast and their free cash flow margin forecast, while affirming their product revenue forecast, and the shares were up about 13-14% yesterday. So the appetite is there for any good news on this. I mean, I wouldn't call Snowflake a small cap, but it's, you know, it's not a mega cap. So, I mean, we had that there, and Snowflake has been making a lot of announcements. They had the NVIDIA announcement, they had a Microsoft announcement on top of this long-term operating model announcement. So, so you saw a big move there on Snowflake. But then when you look at some of these fallen angels, I mean, we had Walgreens Boots Alliance. Now, they reported and they were down around 9%. And to be honest, they're having a lot of issues. I mean, they're still doing incredible amounts of revenue, you know, 140 billion revenue for the year, which is, but the thing is that the trajectory of their profit is declining. They have their margins that are being squeezed, and they have their healthcare segment, which is still not making a profit. And in fact, they lowered the outlook for their healthcare sector. So they were hoping that this healthcare sector would start generating profits like pretty soon, and now that's been delayed by about a year. So Walgreens is under the cosh a bit. Yeah. So,
and also they seem to be looking to close 150 stores to try and put some fear into investors. Based on its trajectory. Before, you know, if we look just a couple of years ago, well, especially during COVID, there was just a bit more of a euphoric state on Walgreens, because obviously the jabs would be administered there, and, you know, all the extra revenue that could bring.
I mean, that's the biggest thing right now. It's actually the COVID jabs. It's like the COVID headwinds. Like if we look at what they were actually saying, they were expecting another booster shot to administer like in the fall, and there's a much lower take up in COVID-19 vaccines shots, which they assumed would be much higher in their prior quarter. So that's why they cut their outlook for 2023. So there's that, and then, you know, they're also still struggling to find pharmacists to fill their pharmacy unit, although they have improved quite a lot, but, you know, they've had to be working on a reduced operating schedule. So now they've still got they've improved it by about 500, but there's still a good amount of pharmacies that are on a reduced schedule because they don't have enough pharmacists. So, I mean, Walgreens was a bit down 8-9%. And again, Walgreens is a bit like this AT&T. It's all hinges on their real juicy dividend. But now there's talk that the dividend is under threat, because, you know, the free cash flow is quite not there. Like, they had negative free cash flow, and so then the thing is that how they're going to keep on supporting these dividends if you're going to have these negative free cash flow. It's pretty crazy. It was like a negative 444 million, and they've been counteracting this by all these asset sales. But now that like, and how many assets can you keep on selling to to support these dividends? So the question is their dividend, which is the crown jewel in their investment thesis, well, why you get into Walgreens, is that under threat? And if it is, could be a bit of a rough one for. Although their revenue is still good, but in terms of profitability, it's not as great. And then yesterday,
you just have to be scared, well, not scared. You have to be cautious when it comes to chasing yield. You know, especially with these type of stocks in this environment.
And then the other thing was we had Micron yesterday as well. Now, Micron shares, they open up higher by about 3%, and then now they're lower by about 4%. But you know, for those who follow the page, and I do plan to do more updates of this, they reported their Q3 loss, which was better than expected, and the revenue was better than expected, but their Q4 was a bit light. So I did a bit of a summary, a rundown of their earnings, and basically Q3 was ahead of consensus. Their gross margin and their operating margins were hugely lower, but they beat consensus. But their Q4 EPS and revenue, EPS was light, the revenue was in line, and the gross margin was light. But they did make some comments in regards to the chip industry, saying that they're confident that the bottom for the quarterly revenue has passed. So now they see growth going forward. And then obviously they've had this huge issue with China on this China. China basically stopping people from using their chips. So they're saying it's going to have a huge impact on their business. This was a decision back on May the 21st. I'm reading it here on their slide deck. And they said that Micron is working to mitigate the impact over time and expects increased quarter-to-quarter revenue variability, although their long-term goal is to retain its worldwide DRAM and NAND share. So they also gave some guidance for 2024 where they expect their WFE lower year on year, and then they also reduced their wafer starts to approach 30% in both DRAM and NAND. So I do plan to, both of us plan to do these little rundowns after some, any major event or anything like that. So we had Micron, they're down 4% on the back of this, although it was up straight after it. So we got Nike, however some people want to say it, they're reporting after the close today. So that's going to be an interesting one. You've got Tesla delivery numbers also probably over the weekend. So, I mean, what's your take on that? Where do you see it happen? Where do you see it going?
From a margin perspective, I'm a little bit concerned, and especially because they've got all these factories coming out. There's certain people out there that are saying that Tesla might need to come to the markets to raise, and if that does happen, you can see a bit of a lot of volatility in the stock. It's obviously
that must be some fun. Surely, I haven't heard that.
Yeah, no, I mean, because their free cash flow declined quite a lot in the previous quarter, and especially now the cars that they're selling at the moment are much lower in terms of average selling price compared to the backlog they were pushing out in Q1. We're really going to see the impact of those like a full quarter of those lower prices. So, I mean, I hope Tesla hit it out the park and do like 460, 470K deliveries. I'm just trying to be cautious right now with.
It's interesting what you say because obviously we've seen this big run up in Tesla, which has been underpinned pretty much by their adoption of NACS started charging standard. Pretty much today we had Volvo come out, that's after Ford, GM, Rivian, and pretty much there was I think you sent it to me, Electrify America, they're looking to do it. There's a lot of people when you talk about them and why did you go for a Tesla, and they go, even though I like another car better, it's just the charging and the charging was like one of the biggest draws to a Tesla. And so now that everyone's going to have access to that charging and it ain't going to be an exclusive club anymore. Again, I don't know how much it's going to impact their sales or not, but Elon Musk did actually, I remember he did tweet about this not too long ago and saying, this is probably going to hurt us more than help us. But the thing is that we have to just do it to advance the use of electric vehicles. And this is what it is. It's going to be very interesting going forward.
It is going to be interesting to see how it really affects the bottom line. Remember, all of those buyers are going to be pulling up to Tesla branded chargers, Tesla everywhere. They'll be able to talk to Tesla owners that are there as well. I think it's right now it's still a like EVs versus not EVs rather than inter-brand competition. And I think it's the right move to try to push it so everyone who has had negative thoughts about getting an EV because of charging and they didn't consider a Tesla, they just they're loyal to the Ford brand or whatever it is, getting them into an EV is positive obviously for the EV movement in general, but also it's like Tesla are going to be making money on all of those charges as well. So in a way, I mean, obviously you can't compare the financials, but would you rather be at the Exxon petrol station or would you rather be, the Ford that makes the cars, like, in terms of a margin perspective, right? Because especially with the mega packs, coming to all of these charging stations, potentially, the profits there are going to be, hopefully quite good. And especially in terms of government subsidies, etc. It's going to the cost for Tesla to create these stations will hopefully be coming down, especially where funding was going to Electrify America, especially for their open standard or the CCS standard. Really going to see how it works out, but I think it's a positive for the industry in general.
Yeah, I mean, you know what it is? It's even though they're going to have it just to have use of both, because I mean, you can still probably put a CCS, you can have a CCS adapter and so use it at both. And so as long as both are available, then that's great, to be honest with you. And I think the real interesting thing short term anyway is now you're seeing so many incredible deals like on the Ioniq 5. If I really needed a second car, which I don't, but I mean some of these deals that these manufacturers are doing, because now the waiting lists are pretty much all gone for most EVs. Like you can literally go to a lot and just pick up any EV you want. And the thing is that there's how times have changed from all of these premiums and markups that you had last year and now, for example, on the Ioniq 5, even though it doesn't qualify for the $7,500 tax credit, they're giving on leases $7,500 off. And then there's crazy deals like put $5,000 down and it's like $350 a month, $400 a month, which for that type of car is an incredible deal. So I mean, if only I needed a second car, a second car of that sort of magnitude. But yeah, at the moment, I just want to get one for the sake of it. But what's the, it's crazy. But it just shows how much these prices are just going to keep on coming down. And the used car prices, whew, I mean, Tesla used cars, I mean, they're so cheap right now. It's just insane. So relative to what they were anyway. So
definitely. It's it was unsustainable. The types of margins they used to be adding, but in terms of still, all of the legacy automakers still can't deliver on their promises in terms of production numbers, and that of what they were stating a few years ago, or even this year, where they're going to be. There's still production is still limited. It's just they've kind of fallen. EVs, especially in the UK anyway, have fallen out of favor because of large increases in electricity costs. But yeah, there's phenomenal deals. If you are on the lookout for a runaround car, there's no better choice than EV, especially if you have access to off-street parking or those lampposts where you can charge. It's just a no-brainer in terms of the lack of maintenance and all of those things. So yeah, it's just a positive to have more EVs flooded onto the market, I guess, apart from if you're trying to hang on to residual value on your existing purchase.
Cars are back to normal. It's not an investment. Yeah. I remember my Volkswagen Jetta I sold at a $4,000 loss over almost 4 years, which was incredible. Like normally that would depreciate about 11, 12 grand, and it only depreciated 4 grand. And that was in one accident as well. So even without the accident, could have been a grand more. But with this my Mustang Mach-E, it's gonna be just the way it is. Yeah, I mean, I'm going to keep it short and sweet today. We are going to, going forward, start doing a few more deep dives, although we talked about it in the past, but talk about some of the, the getting into the weeds and some of these stocks and some of the inner workings as we approach earnings season coming up in a couple of weeks. We're going to have the banks reporting again middle of July, and we're going to be at the halfway point of the year. So it'll be very interesting to see the trends that are emerging from this economy. I mean, so far right now, when you look at all the companies that have reported, still macro headwinds, deteriorating consumer, that seems to be the general trend. Even though there's no real recession or anything like that, but in terms of happy-go-lucky spending like we've seen before, that definitely seems to have dialed down a bit. So let's just see how that translates. Obviously, we're going to see big AI numbers. I saw this headline yesterday that Oracle plans to spend billions on NVIDIA chips, and that came after or before there was talk that the Biden administration is looking to stop exports of AI-related chips to China, which led to a little bit of a fall in NVIDIA. I'm a bit short, so I wasn't complaining, but yeah. It's going to be interesting. Like, I mean, near term, the demand is still huge, but it's whether it really turns out to be what it's all cracked up to be, and that time we'll see.
Yeah, it's a difficult one because we know that the cost per, I guess, training unit is going to come down significantly over the next few years. And it's like, do you invest right now and spend billions on A100s from NVIDIA, or do you just wait a little while, let the market kind of figure things out in terms of which direction it's heading, where the demand is, where the profitability is, in terms of products that will be really up there, utilized by customers, or where the innovation could come in. We're still so early in the game. These companies have to have a real clear plan of where they want their AI services and their offering to be, and also how easy will it be within like 2 or 3 years time to just completely, like, to train something that would cost like hundreds of millions, would potentially cost $1 million or even less in just a few years. I see a massive, like, greater than Moore's law, just like a huge exponential decrease in compute costs based on hardware and software capabilities. So it's amazing to be a part of this whole thing. But it's just, where do you put your chips? Do you put it with the hardware guys? Do you put it with the software guys? Or is it going to be someone that we have no idea, just going to come out of the woodwork?
Yep. Well, we'll see how it goes. Well, please like and subscribe if you like what you heard, and we'll catch you on the next one.